Hey everyone, welcome back to the channel, which is all about how to generate passive income from a diversified portfolio of high yield funds. So today's topic is going to be about GICs, or guaranteed investment certificates. In the US, the equivalent would be CD, certificate of deposits, right? That's how it is in the US. So they're getting more and more attractive because GIC rates or CD rates are rising, right? They rise with interest rates. So they're getting more and more attractive, and they're pretty popular with low risk investors or retirees because they want guaranteed income. So I'm looking at the EQ Bank, which is a popular one that typically has the highest ones in Canada, and you're looking at 3%. I see 3% here on their website for 9 months. For 2 years, you're looking at 4.6% a year. 3 years, it's 4.7%, and for 5 years, it's 5% a year. So very, very unheard of, right? It's been a while since GIC rates have been so high, but I'm here to tell you that they are a very bad investment, and you shouldn't invest in them. So we're going to go through 4 reasons why I think you should not invest in GICs, but more importantly, I'll give you some alternatives, some safe alternatives that you could invest in where you get much, much better bang for your buck, let's say. So let's get into it right away. First reason why GICs are a terrible investment is what it actually is. So most people don't even know. If you think that you're just leaving your 5,000, 10,000 or 50,000 at the bank for 3 years and it's staying in a vault somewhere, you are sadly mistaken. So how do GICs work? Trusty Google, of course. When a customer of a bank or credit union purchases a GIC, they're lending their money to the financial institution and you get a certificate. So you're lending the bank money, and the bank will then lend out your money to other customers at a higher interest rate than what they're paying you, usually mortgages or loans. So you're literally giving your money away to the bank so they could profit off of it. I mean, it's completely ridiculous if you think about it. Yes, you get that guaranteed investment, but I think what's really guaranteed here is that the bank will profit off of you. So that's number one reason why GICs are a terrible investment. Reason number two, and this is very straightforward, and obviously everyone could think of this, is your money is locked in. So usually if you take a 2-year, 3-year, 5-year GIC, your money is locked in for that period of time. So if you need that money, something happens, you usually have to pay big penalties to break the contract, and that's basically it. So you could pay a lot of penalties if ever you have to have access to that money. So obviously it's very inaccessible during the time frame of the GIC. So that's also another reason why it's a terrible investment. Reason number 3, why is it a terrible investment? Well, it's very, very tax inefficient. So GICs, when you get the money or the interest, it's considered as interest income. Interest income is the worst form of income in Canada. It falls under the category of basically your marginal tax rate. So paycheck, salary income, rental income, if you own an apartment building, foreign income, interest income is all in the worst category. So in Canada, the easiest way to think about it, I don't want to get into it too much here about taxes because we could talk about taxes for a while. If you really narrow it down, there's really 3 tax categories. There's the first one, which is the worst one. So according to your marginal tax rate, basically. So interest falls under this category, which is what GICs give. Salary income, foreign income. After that, you have eligible dividends from Canadian companies, which is a bit better, which is about 15 to 16% better taxed, more tax efficient. This, of course, depends on your province, your marginal tax rate, but it's typically a little, I would say 15 to 16% better for sure than interest. And then you have the third category, which is the best category, capital gains and return of capital. So return of capital, it's not taxed at all, but it's really delayed capital gains. So I'll put return of capital and capital gains in one basket here. So capital gains income, when you buy something low and sell it high, or even capital gains income from an ETF, is the best taxed. Or it's the most tax efficient in Canada because you're only taxed on half of it. And the other half is taxed according to your marginal tax rate. So it's literally 2 times better than interest. So this is another reason why GICs are a terrible investment. They give you interest, which is the worst form of income, taxable income in Canada. And reason number 4 is there's much better alternatives out there. You have no excuse now, everyone. Okay, it's a bit of tough love here, but It's very easy to get a broker and invest on your own in something much, much more tax efficient. It's still very safe. So there's a lot of great alternatives out there. And I'm going to discuss the alternatives right now with you to give you a few examples on how you could do much, much, much better than a GIC. Alternative number one, and this is a no-brainer if you really think about it, why give your money to the banks when you could just buy the banks? I mean, it's very straightforward, and investing in, the Canadian banks, they're considered the safest and some of the best in the world. It's very easy to do so, but it's even more easy to do so now. I'm going to give you probably the safest option to do so. So you could invest in the individual banks and the individual stocks. You could get an ETF that has all 6 banks equally weighted. That's even safer because you have all the banks. But there's even a safer way, is getting a covered call ETF with the Canadian bank. So the covered call strategy on an ETF means that the ETF is more defensive. There's less volatility and it's a bit more, you get higher yield. It's income oriented. So it's even more defensive than having just a regular covered call ETF with the 6 banks. So ZWB is the biggest one out there. It's the biggest covered call ETF in Canada. It's from BMO. So BMO manages this. In here, you have all 6 banks. So don't just have BMO. You have the big 6 banks: Royal Bank of Canada, TD, BMO, CIBC, Scotia, National Banks. You've got the big 6 banks equally weighted with covered calls, which means you're getting an extra yield. So if we look at this ETF here real quickly, first of all, it's humongous. It's almost 2.5 billion in size. So it's very, very big, very, very, very popular. And you are getting an annual distribution yield. So think of this like an interest rate, a GIC interest rate, right? You get an annual interest rate, whatever it is, 4%, 5%. Well, this gives you 6.95% right now as of July 8th, a bit outdated, but it's probably around here. So every year that you buy and hold this ETF, you will get almost 7% yield on your money. And that's not even that's just the yield. If the ETF goes up, or if the banks go up in the next 3-5 years, you also have capital appreciation. So 7% a year is pretty much your minimum return, and you can make even more. If we look at the performance of this ETF since its creation, 2011, I believe it is, on average, you're looking at an 8.22% return. That's the income or the interest and the capital appreciation. So you're beating any GIC rate, even if it's 5 years. Not only that, but it's very, very, the income you get is monthly, and it's very, very tax efficient, right? I was saying before, when you're getting income from an ETF, especially a covered call ETF, you're going to be getting mostly capital gains and some eligible dividends. And I'll show you right now. If you go to tax and distributions, and if you look at the tax summary, let's say of 2021, because 2022 is not there yet, if you scroll down, you see all the dividends here, which, by the way, can increase as well. That's another advantage that the 6 banks have. They tend to increase their dividends. So this ETF has increased their dividend here. You could actually see it 8.5 cents to 10 cents. Now it's at 11 cents in 2022. So if you scroll all the way down, you could actually see the breakdown of that 7% that you're getting. So it's not interest income. Most of it is return of capital here, which falls under the capital gains category. So a lot of it's going to be capital gains and return of capital, which falls under the capital gains category. And there's going to be obviously a lot of eligible dividends because these are Canadian corporations. So a lot of the income is going to be eligible dividends. So either way, the eligible dividends, the capital gains, return of capital, much more tax efficient. So that 7%, not only you're getting more yield, but you're paying less taxes on it. Absolutely a no-brainer here. And like I said, not only that, you have the chance of increasing dividends as well. The banks typically increase their dividends all the time. And as you can see, now it's at 11 cents a share. So there's literally a 10% increase that this ETF did, from 10 cents a month a share to 11 cents. So you have no excuse, everyone. Stop giving your money to the banks. I don't care how attractive the GIC rates are. Buy the banks instead, in the safest way possible. There's no leverage in this ETF. It's a very boring ETF that typically grows slightly over time, or the stock chart is very boring. That's the point. So it's the stock price, but you're getting that 6-7, right now it's almost 7% interest or yield a year on it. So you're going to completely destroy any GIC. And ZWB is just one example. I'll give you a couple of other examples here. ZWB is the biggest covered call ETF that BMO has, but they have an entire lineup of covered call ETFs. You see ZWB here. But you also have ZWC, which is a collection of Canadian dividend stocks. You have 6.78% yield. You also have a utilities one. So utilities companies, so electricity companies like Fortis, Emera, Hydro One. They also have telecom in there, AT&T, Verizon, Bell, TELUS, Rogers, some pipeline companies. So utilities is a very safe and defensive sector in the market because these are essential companies. They provide electricity and data and telecom. And this one gives 7.5% yield, even higher than the six banks. So another option you have is also a preferred share of a split fund, right? So the biggest split fund in Canada is called Dividend 15 Corp, which has about 15 high quality dividend stocks, and more than half of it is the six banks and the insurance company. So all six banks are included here, but you also have great companies like Bell, Manulife, TELUS, Thomson Reuters, TransAlta. So a nice mishmash of very safe, good quality, boring blue chip stocks on the Canadian stock market. But this is a split fund, so there's preferred shares and there's a Class A share. So we want to go conservative here, right? So you're gonna only deal with the preferred shares. I'm only going to talk about the preferred shares here. So the stock symbol would be DFN.PR.A, and the preferred shares literally give you about 5.5% yield. So 5.5% interest basically per year, and it's not as much as the other one, but the advantage of this one, this is perfect if you're really scared or if you're very new, because the stock usually, this is the stock chart from the last 10 years. It's always about give or take $10. So the stock always stays at $10. So your capital doesn't fluctuate pretty much at all. And you're making that I think now it's 5.7% yield every single year. Not only that, but the yield that you get is not interest, it's eligible dividends. So if you look at the tax breakdown for the dividends of the preferred shares of DFN Split Corp, you see here preferred shares, you'll see that the whole dividend falls under the category of eligible dividends. So you're getting a slightly higher yield, barely any fluctuation with your capital, more tax efficient income. Another option would be real estate. A lot of people think real estate is really safe. You could go with my favorite vanilla ETF that deals with real estate from Middlefield. Middlefield Funds is a real estate expert, and they have an ETF called MREL, which is not leveraged. They have a leveraged version called RS, which I like. But if you want to stay conservative, don't get any leverage, stick with MREL. What does MREL own? Some of the best REITs all over North America. Properties all over North America, residential, industrial, retail, specialized, office, healthcare. You have all kinds of REITs here, US and Canada, a little tiny bit in international. You could see the top 10 REITs here. Canadian apartment REITs, Granite REIT, RioCan, Smart Centers is in here. So the very good quality blue chip, stable, big real estate all over the world. And how does this ETF do? Well, since inception, this ETF gives you a return, income, and stock price of over 7.5%, destroying GIC rate. So this is another option if you're really comfortable with real estate. And if you look at the breakdown on the income, again, I want to show you the tax efficiency of all these funds. 44%, 43%. So we're talking 85% of the income you're getting falls under the capital gains category. So everyone, you have no excuse. There's plenty of amazing, great, safer options out there that you could invest on your own. And I'm just scratching the surface here. I actually have a video. I recently released this video on June 5th, safety ETFs in Canada that gives you a 6% plus dividend yield. So not only you're getting higher rate in the GIC, you're getting more tax efficient rate. You could buy and sell the shares whenever you want. You don't have that problem of being locked in, because you could, these are ETFs, they're publicly listed. You could buy and sell it, you could redeem anytime you want if ever you have an emergency. GICs, you can't, you'll have to pay a penalty. Here, there are no penalties. It's do-it-yourself investing. You could do what you want. So you could take a look at this video also. There's a bunch of other options in here. I talk about the split fund preferred shares like I mentioned. So you have no excuse, everyone. Here are some alternatives. Please do not invest in GICs, no matter how tempting they are. You are giving your money to the banks, basically, to make more money off of you. So at the very least, everyone, get ZWB, buy the banks instead, and you'll be much better off. It's much smarter. So there you have it. Hopefully this was informative for you, and hopefully I convinced you. Thanks for watching, everyone. Really appreciate it. Make sure to hit that like button, that thumbs up button. It helps the channel grow, so it's a win-win. Also, make sure to subscribe if you're not already subscribed, not to miss out on my future content. It's all about income-focused investing. And also, you got to be subscribed if you want to participate in my surveys where I ask the audience, I ask you what topic you want me to cover next. So very important, subscribe, hit that little bell button so you are notified of any new videos and any new surveys as well. Make sure to check out our website. We have a website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. So this is a reference tool. It's a companion tool to help you build your own custom portfolio. It's good for Canadian investors and American investors. So it covers both the Canadian and American stock markets. It has sample portfolios as well, multiple sample portfolios for different investing styles. So it's a very cool product, and it does come with lifetime updates. So you only have to purchase it once. My intention is to come out with a new version every single year. So you purchase it once, you never have to pay for it ever again. You'll get the lifetime, the updates for free forever. Also, right there on my homepage on the website, I do offer a one-on-one coaching session. If ever you want a little more personalized help, it's a 1-hour Zoom call with yours truly, a one-on-one with me where you could ask me anything you want. We'll go through your situation and I'll give you my opinion on how best, I'll help you best I can, basically based on my opinions. Just keep in mind that I am not a licensed or registered financial advisor or financial planner. We also have a Facebook group, so join us there, Passive Income Investing, over 11,000 members. We try to get the spams and the scammers out of there as quickly as possible. So it's a very, very clean group. Everyone's asking questions, trying to help each other, and it's a really, really cool and fun community. If you want a little bit more personalized stuff on our day-to-day life, follow us on Instagram as well. We recently moved to Panama, so if you want some more information on more personal stuff, you could follow us on Instagram. My mission, the mission of this channel, will always remain the same, everyone. It's to help everyday, regular, normal, working people to invest on their own, do-it-yourself investing, right, in order to build their own stream of passive income to enhance their quality of life and one day become financially free, financially independent. Very important goal. So, as usual, I continue to stay safe, everyone. Stay healthy, and of course, stay passive. See you next time.